Good evening, friends. Hope you are well and doing fine. Thanks for joining this webinar to discuss one of our flagship fund, HDFC Top 100. As you are aware, Top 100 has been in operation for more than 25 years. And with me is Rahul Baijal, the fund manager for HDFC Top 100. And before I introduce Rahul, let me set the context for this webinar. The common perception is that when it comes to large cap strategies, you are better off doing a passive investing, that is, invest in index funds, because the belief is that large caps in general do not outperform their respective benchmarks. So I thought let me start sharing with you what we are seeing as far as large cap is concerned, or at least the top 100 is concerned. If you see on your screen, this is the performance of top 100, 1 year, 3 year, 5 year. And what you see that it is doing better than the category average, which is large cap categories across time period, 1, 3, 5 years, as well as when you see the performance vis-a-vis the benchmark, it is even outperforming the benchmark also. So top 100 is not doing better than category average, but it is doing better than the benchmark. And it's not only about the lump sum investing. When you look at even SIP route and across time period. So as I said earlier, that this has been in operation for more than 25 years. And if you see since the inception track record, if you would have invested at the rate of 10,000 a month, nearly 32 lakh rupees, it is worth more than 6 crores or nearly 7 crores rupees today, giving a return of nearly 18.5%. And similar stories you can see across time periods, sometimes more, sometimes less, being equity being the volatility being the nature of the equities. You see differing performance, but they are all in double digits. So therefore, the title Elephants Can Dance Too. Though the perception that, for a large cap strategies, it's difficult to beat benchmark, difficult to create returns, that sort of myth is getting busted when you see the performance of top 100, and not for 1, 3, 5 years, across the time period when you see the scheme has delivered handsome returns and beating the benchmark also. So therefore, we thought the time has come to clear those myths and have the man in action, Mr. Rahul Baijal, who is our senior fund manager, who is managing the strategy. Rahul has been with us for over a year now, but on an overall experience basis, he has more than 22 years of experience of research and equity fund management. And prior to joining HDFC, he was with one of the other AMCs where he was managing similar strategies. So Rahul is a hands-on as far as large cap strategies is concerned, has the experience of managing large cap strategies. And over last 1 year, when you look at the performance, he has demonstrated an excellent record there also. So without wasting much time, without much ado, I thought, let me first clear this myth that large caps don't deliver. Active large cap strategies do deliver. Elephants do dance. And Rahul will help us explain, understand that what he does with this fund, how does he manage this fund, and what are his thoughts going forward. And after his opening remark is done, we'll open the floor for question and answers. And of course, with me as usual, my colleague Ram Kumar is there, who will help me moderate the call. Without much ado, over to you, Rahul. Rahul, investors, distributors on this call. Thank you.
As you mentioned, on the large cap category, a lot of debates going on in the last few years. So I'll also put my comments on this active versus passive debate as I go into the presentation. So what I have today here is basically an update on HDFC Top 100, which, as you know, has been a flagship scheme over here. And I have divided the presentation into 3 parts. The first part will basically address large caps as a category, the attractiveness of investing in large caps, and here I'll come back to the active versus passive debate, and why stock picking matters and how it can make a big difference in terms of outperformance creation. The second part of the presentation will be more about the portfolio strategy being followed here and the risk management principles which are being followed in this particular product. Lastly, I'll end with showing you how the positioning of the portfolio has changed over the last 1 year and how is it positioned for the future. So firstly, on the large caps, as the title suggests, in a way they can be compared to the elephants. They are clearly large in size and stable. And if you look at the bandwidth of companies in the top 100 names, which is basically the definition of large caps in India, most of these companies have, traveled the journey across the last 2-3 decades of moving from small cap to mid cap to large cap. And as they've traveled this journey, they have become very well researched. The management bandwidth is well established, long track record, and they've shown stability across various business cycles over the last 2 decades. And that's why they've managed to reach the large cap top 100 names. So clearly, they come across as very proven business models. And if you look at the return track record and just look at point-to-point returns, the large cap index in India, unlike many other emerging markets, has given a fairly steady compounding over the last 18 years or so. And herein, I'd like to come into the active versus passive debate again. I think in India, if you look at the last 5 years, if you look at certain points in time, especially after years when you have had narrow rallies, do you see in general large cap performance of many mutual funds underperforming the market, the benchmark returns? Or if you have a very fast rotation in sectors like in 2020, that happens. But if you look at longer time horizon, 3-year, 5-year, last 2 years, and when the economy is doing well and there is broader participation of sectors and more scope for stock picking, it is seen that, in general, many large cap funds do outperform the benchmark. And if you go back and look at the peer group right now, you'll find many such funds are outperforming, and obviously the scale of outperformance differs. So clearly, it's not right to look at one point in time, 2-3 years back, and form this conclusion that passive may be better than active. It may be for a shorter duration, but I think over longer duration, 3 years, 5 years, large caps clearly have potential to offer stock picking, and which can over course of time lead to significant outperformance. And two, I think if you look at passive returns, let's say in this index over the last 18 years, it's given a 13% CAGR. Even a 1 or 2% additional alpha, and I think this is very important, even a 1 or 2% additional alpha over the benchmark return does make meaningful difference to the amount of money that you can compound over long term. For example, let's say last 10 years, you have a 13% CAGR, and 1 or 2% extra CAGR, if you do the calculation, will lead to 10 to 20% higher absolute amount at the end of 10 years than what you had 10 years back. So the point is that I think it makes more sense to go active in allocation than passive. Then coming on to the category again, this is a very interesting slide and which I really like, and it basically sends 3 messages. Firstly, if you look at India over the last 3 years, 5 years, 10 years, there's been an excellent creation of track record of returns. And these are rolling returns, not point-to-point returns. So if you look at the large cap index, and we're talking indices here, it's given about 12% compounding very consistently over 3 years, 5 year, 10-year rolling returns. And surprisingly, the small cap index across these time periods also has given similar kind of returns at around 12%. And the mid cap index, as expected, has given about 15% compounding over 3 year, 5 year, 10 year. Now, these are index returns. Obviously, many small caps and mid cap schemes, including ours, have done much better than the benchmark. So the compounding is much higher. But this is just to give a perspective that over a long term, rolling returns, large cap index returns have been fairly attractive and as comparable to the small cap index, as you can see, almost the same, although the mid cap index returns are about 3% higher. And another interesting thing which comes out is that if you look at the standard deviation, which is a measure of volatility, the volatility across the three asset classes is the least in the large caps. And when you divide the average return by the standard deviation, you get a measure of risk return, which is the risk return ratio. And that, my friends, is the highest for the large caps across 3 year, 5 year, 10 year. So if you look purely at returns, but ignore risks, you have a certain set of returns. But if you look at risk adjusted returns, actually the large cap indices have given the best return risk return ratio in India on a 3 year rolling, 5 year rolling, and 10 year rolling basis. And that's why this is one of the favorite asset classes within equities in terms of market cap curve for the FIs to invest in India. And most of the $600 billion which you find in India, most of it is invested in the large caps from a risk return perspective, attractiveness. Another interesting thing about large caps is year over year, we don't see the change. But if you look at longer term, the index composition keeps changing. So 18 years back, Nifty 100, the 100 names which are there, if you look at the index now, you'll find only 40 names have survived in the large cap category. And the remaining 60 names have either got merged, got acquired, got bankrupt, or got demoted to mid caps and small caps. So 40 out of the 100 names have survived over 18 years. And therefore, you have to pick the right names because stock picking over a longer term does matter in large caps as well. And this is a very interesting example of, the same. So that's some perspective on the large cap as a category. And then coming on to the top 100 fund, as you all know, and as Shoghi mentioned, that it's a flagship product over here, long track record. So what's been my approach in terms of the strategy? Broadly, in terms of the investing style, it remains the same. It's a blend of GARP and value, and portfolio construction is done on a blend of bottom-up and top-down basis. Here, I want to say that I think in terms of the bottom-up feedback, the analyst rigor, the depth and the width of coverage in a much superior manner. And I think this is a function of the long drawn processes tested over time, which have been set up over here. And coming on to valuations, this product, my approach remains to be valuation sensitive throughout the journey. How I approach growth and value is a bit different. When it comes to GARP, within part of growth investing, my tolerance for entry-level PE multiples when I'm doing stock picking, and my tolerance for exiting when I'm selling stocks is a bit higher, especially when I see when the quality of companies is good and there's a long runway of growth and clearly sustainable sustainable competitive advantages exist. So I have a bit higher tolerance level for the P multiples and some GAAP bias. And on value front, I'm quite choosy. For me, it's very important to have visibility of catalyst within a reasonable period of time. And that reasonable period of time for me is about less than 2 years. Anything more than two years, or if there's more of a hope that something may happen over a medium to long term, is something which I'm not tolerant about. So that's my approach to GARP investing and value investing. And this product is following a blend of GARP and value, like in the past. Portfolio remains optimally diversified with about 50 stocks, 55 stocks. And the portfolio construction is from a medium to long-term perspective. Now, again, the beauty of large caps is that management's business models, balance sheets have been time tested over a long period of time. And therefore, inherently, you find the investment is a bit lower risk, because the risk of implosions in terms of business models or managements going off track, which we often see in some of the smaller names, the risk from that perspective of companies and businesses creating negative surprises, the chances are much less. And that's why they're called well discovered and well researched universe. From a risk management perspective, again, this product used to have a benchmark overlap of about 50 to 65% over the last 10 years. That continues. And a few contrarian calls, like in the past, keep being taken. And there's also some flexibility to have mid-cap exposure in the range of 5 to 15%. On the risk management front, while high conviction bets are being taken and active calls are being taken, but I'm doing it in a more controlled manner. The sector deviations and stock deviations, there's a framework which I follow, and that keeps the benchmark overlap between 50 to 65%, while actively taking calls on rest of the portfolio. So that's a risk management approach being followed. Then on the back of all this, coming to the positioning of the fund, on the back of this framework, which I have articulated on portfolio strategy, this is the current positioning. On the top end of the overweights, you have financials and healthcare. And at the lower end of underweights, you have IT and materials. This is a positioning which has come on the back of a lot of changes done over the last 12 months, mainly in the first 6-7 months. So you had around 13 exits in the portfolio and about 8 new ideas, on the back of which the sector positioning has changed. If you look at the portfolio between 31st July 22 and 31st July 23, broadly, within sectors, there have been a lot of changes, but in terms of direction of the portfolio, it remains the same: overweight in financials, healthcare, utilities, and communication services. The only two sectors where the direction of the overweight underweight has changed is industrials has moved from overweight to marginal underweight, and energy from a large overweight has moved to a underweight. These are the two big changes in terms of direction of the overweight underweight. The rest of the sectors, the extent has changed, but the direction of the overweight underweight has remained the same. But within sectors, there's been a lot of churn in terms of stock picking, like I mentioned, 14 exits and 8 new ideas. And overall, from a 50-50 growth value positioning 1 year back, now it's positioned more like a 60-40 kind of a growth value approach, with 60% towards growth and GARP and 40% towards value. Other metrics, broadly, If you look at the bottom, the portfolio turnover ratio has broadly remained the same. 1 year back, it was about 15%. It remains the same. And in terms of large cap, which is 89% as per the mandate, and mid cap has a flexibility of 5 to 15%. Right now, it's about 6%. And like I mentioned, in terms of benchmark overlap, in the past, it's been run like a range of 50 to 65%. Right now, if you look at the right side, it's about 65%. So it's at the upper end of the range. And as there is more visibility and conviction in the growth recovery ahead, this overlap may reduce further over the next 12 months. So in terms of positioning, this is what we have as of now. So I kind of covered some ground in terms of the large caps attractiveness as a category, the active versus passive debate, and I've talked to you about the portfolio strategy being followed over here, and the outcome in terms of positioning. I think I'll pause over here.
Thank you, Rahul, for your excellent presentation, and Ram for moderating this call. And thank you, guys, for being on the call. Thank you once again. We can close the call.
Thank you.
Thank you very much. Thanks, Rahul. Thank Ashokji. Thank you.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.